Anne-Marie. We have you live on Benzinga's Pre-Market Prep, brought to you by MarketFi. How you doing this morning?
I am doing very well. I feel like I live in Narnia now because the snow never leaves.
You got some snow there, do you?
Yeah, well, it's just been sputtering for, a week and a half or so, but whenever it snows, it just never melts. I mean, you guys know. You're just down the street from me.
Where did you move from, Anne-Marie?
North Carolina.
North Carolina, and now you're in snowy Michigan, and you haven't been by the office yet?
I know. I
Well,
know.
we'll
I
have to
need to make that happen.
we'll have to send Joe's limo driver out there to pick her up and
There you go.
bring her back in. But wow, what a jam-packed week we have with earnings. And I know last week when we were talking to you, and I was thinking about it, and I think I mentioned it in the show, and you just kind of felt like the market was kind of just, it was a tough buy and a tough sell, ahead of the
Hmm.
QE and everything, and QE for Europe. We did get a nice move. It faded a little bit on Friday. Big pullback overnight, but we're right back unchanged. You getting a little better feeling here? Or you still gonna just ride out the earnings season?
It's still very unresolved. I mean, to me, when I look at any image of the market, the first thing that I try to think about is, wait a second, what are the majority of players believing right now? And the candlesticks tell me that everything's in a wait state. If you take a look at something like, if you expand all the way back and you look at something like a weekly or a monthly chart, you'll see that all these candlesticks have these long wicks and they're whippy and toppy and frothy. And all of that just tells me that we're in a state where we really are. We've done massive acceleration. We've been moving straight up since 2012, just about. And so we have to take a breath. The market's all about the exchange of energy. And what we're seeing right now is just the charts taking a little bit of breath. But for those of us that have been around for a long time, we've become accustomed to this new state of volatility. I don't know if you remember the months in the summer and sometimes way back when, where we would be lucky if we'd move 3.5 points for an entire day on the TF or the ES or something like that.
Oh,
I
I
mean,
remember,
really,
Anne
we'd be
Marie.
looking. What's
I
that?
I remember. I remember those
Right?
non-vol. I hate those.
And
As a trader, I hate those days where we move 2, 3 points because it's so
absolutely.
hard to make money when the market doesn't move.
Absolutely. And now the market is still not moving, but what it's doing is making these wide rubber band expansions. And so there's room for us to trade, but if you're trying to position trade, right? If you've got a portfolio that you are looking at saying, all right, how can I capture alpha here? What we end up seeing is a net sum gain that's really close to zero right now, no matter what we're looking at. And so I really think, I said this back in November, I just think this whole first quarter is going to be just like this, just nasty and choppy and just caught in a wide tradable range for those of us that are intraday, but really annoying for those of us that are looking to trade trend and trade breakouts or breakdowns. We're going to get continually stopped out if we are that kind of trader.
So, Anne Marie, is this the fade trade then playing out? Because I've been talking about this for a while on the show. It seems like every time you have a big move in one direction, if you're fading that move, you're getting rewarded. Where before it was just buy the dip, the market continues higher. Now it's like buy the dip and sell the rip is working.
That's exactly right. Because we're caught in a very nasty channel. It really is. It's just wide, and it's. Here's the number one thing I've been telling folks: don't buy the breakouts, don't sell the breakdowns. Wait for the chart to confirm. If it does, run the short cycle into the next region of support or resistance. If it doesn't, be glad that you stayed out of the trade and watch it recycle again. Because really, that's all we're doing. We're watching a sine wave that's just moving back and forth with these jagged edges. And they are jagged. They don't even give us time to sort through things. It's up, and then we might have 2 or 3 candlesticks in some range, and then we're back down again.
Well, look at the overnight range here, too. It's the same thing. We got murdered on Greece overnight. We were down 19 handles. If you were waking up at 2, 3 in the morning, you thought, oh, it's going to be a real rough day here. Well, if you're waking up late at 8:41, you're like, oh, it's another good day. The market's up 2 points. We've already recovered the entire losses from the worries over in Greece.
Right. And then some, right? Because we're positive now.
Yeah, we just went positive here just now in the S&P futures.
Yeah.
After trading down negative the entire session.
I know. I watch the weekly pivots, and I use the Woody's pivots because I find those to be extremely reliable.
Could you explain those, Anne-Marie? Could you explain those? You said Woody's pivots?
Yeah, Woody's pivots. Pivot points are calculations based on the prior range of motion. And so there are all kinds of ways to calculate different kinds of pivots. There are like 5 or 6 different kinds. And so they're automatically, most platforms, you can just throw them up there. And when you have easy numbers that you can just throw up there, like a moving average or a pivot point, people tend to trade around them. And a lot of simple algorithms look at those weekly pivots because it helps them establish their range of motion that says, okay, this is where I should start squeezing my buy events off and then watching for support to lose so that I can short into the next region of support. And so these weekly pivots are really a pretty good view of what it is that the chart's doing in terms of being elastic. And I've really, just for the last 3, 4, 5 days, along with the 50 simple moving average, we're either swinging up and coming back or losing the level and coming back to test it. So you can see that there's some sort of magnet sitting there as the charts resolve. And to me, what that means is nobody with big money is putting their feet out saying, this is where we're going. As long as that happens, as long as the big money is not committing to accelerating outside of these ranges, that's all we're going to see is the ranges.
And where does the weekly pivot come in the S&Ps today?
Okay, all right, let me look at.
Because I like to do the dailies, and I like the dailies more when they coincide with like another level. So just to give you an example how I'm using it today, 49.50. That's the daily pivot from Friday. I like that around the also being around that nice round number of 2050. So as you know, the fade trade being down 25 points lower, to me, at least when it comes up to that daily pivot the first time, to me, that's going to act as pretty good resistance. We're still 4 points away from there.
Yeah, that makes good sense. That makes good sense. I don't use the daily pivots because what I try to do is hold out for the bigger move, and sometimes the daily pivots, because of the nasty price action and indecision floating around, sometimes those can get really tight, and it doesn't allow me to watch for a range expansion event, right? And so that is the only reason that I don't use them, but they're absolutely as valid as the weeklies. Now, the SPX, the S&Ps, show us up at resistance level 1 and coming back into the 50 daily moving average. And so all of that, to me, that number that you've got there, that 2050, is a great number for us to saw around, simply because we've got the 50 simple moving average there on the day. We've got the 50 there on the 4 hour. We've got prior support that's a little bit sloppy just around that area, and we're rejecting really a little bit of a toppy action there at about 2063, 2064. That's really in the short term. That's really a little bit of a topping space. So what we're really defining over the last couple of weeks, maybe 3 weeks, is a new range in the SPX between 2065 and 1991. And so that range is starting to squeeze up. Now, here's the great thing. As we squeeze, energy gets built up. You know, I'm always talking about that energy in the market. And when it's like a balloon that gets punched full of air. We just keep blowing and blowing and blowing. Eventually, it's going to be so coiled that it's going to burst. And it's going to move in one direction or another in somewhat of a fierce move that may retrace because we've got this jagged action, but then it'll move in that general direction. And so we are setting up that squeeze. Now, the problem is sometimes a squeeze can last weeks, months. So don't know when it's going to resolve as of yet, but I do see all these moving averages tightening up. If you look at that 4-hour chart, I love the 4-hour. People don't look at the 4-hour nearly enough, I don't think. But that 4-hour chart has got all the main moving averages, the 10, 30, the 200, the 50, all of those coming together. And the tighter they squeeze, the more energy they'll compact. That'll make an expansion outside of those ranges I mentioned pretty important.
Anne-Marie, let's move on to some individual stocks here. We've got Madrid in the chat who's interested in Marvel, MRVL. Is this a stock you follow? Marvel Technology?
No, a long time ago. I used to look at them, but I haven't lately.
Trying to put a bottom in here, huh?
It does appear that way.
It's kind of sloppy chart, though.
It's a little bit sloppy. Always Harlan Pine.
Yeah, and it looks like a broadening upside wedge, which makes for very erratic motion, right? And yeah, that one's a little bit sloppy. But you could draw a pretty solid trend line on that. The bottom line is this a place that I would go long here? And
nope.
It's got momentum, but it's jagged. And so I'd rather see things tidy up a little bit. And, if it could hold a nice little line above 1590, 1595, it'd be a better bet. It's not a bad thing, certainly from a momentum perspective. It's not a bad thing at all. It just has a line of sellers that are really serious about not letting us get over 16.
Okay, we got to ask you about Apple. Has earnings this week. It, a little boost in pre-market trading from positive notes from Gene Munster over at Piper Jaffray. You're going to be doing. We talked about the $6 straddle earlier in the show. What are you looking for in Apple?
That $6 straddle is not a bad idea. If you don't have it this expiration week, because I think the volatility is going to make for that one's going to make for maybe a little bit of trouble. The bottom line is I totally agree with that strategy because we are going to have range expansion here. The question is how much and how fast. And so when we look at Apple, it's had this really strong group of sellers sitting at around 114.80-ish for a while, and they are defending the region. They've stepped down from it, and they're holding this area. Again, another area where we've got a number of these moving averages squeezing together. For me, I like, although it caps the return, I like the long iron condor here with about a 5-point with a 5-point spread from where it is that we are, but I like it in next week's so that we aren't paying all that volatility. We aren't paying for all of that implied volatility. And so what I've noticed is that the market makers are having a little bit of trouble with a lot of stocks. And so what they're pricing into the chains is becoming more advantageous to the buyer for a lot of these charts that have been moving sideways, that are coiling, have so much energy that they are, expanding in the range. So one of the trades that comes to mind is the Starbucks trade from Friday, where we had a long iron condor. I was reading what it was that the market makers were saying, and that it just wasn't wide enough, nowhere near wide enough, and so it was better for the buyer. I think it's going to be the same thing for Apple, but there's a little bit of a question mark there. So rather than pay for the additional implied volatility, why not take the more conservative iron condor next week? Gives it a little bit of time to expand out of the range, because what we do see Apple doing after earnings is really expand. So if you're looking at a chart that normally expands in whatever direction after earnings, then you're going to be in great shape. If you are looking for that expansion event, a la using the straddle or the strangle or, the long iron condor. So I like, I think Apple's going to be all right. I'm a little concerned about all the negative momentum that I'm seeing in the chart. And then there's this little piece that says, this thing could respond to earnings in a bit of a muted space and then run after 3 or 4 days once people figure out what it is that, they want to do with this. So that's why I'm suggesting the Iron Condor next week as opposed to this one.
Okay, we've been on the line with Anne-Marie Baiynd. She's an author and financial analyst. She joins us every couple of weeks here on Benzinga's Pre-Market Prep, brought to you by MarketFi, sharing her wisdom in the markets. Anne-Marie, as always, a pleasure having you on. Have a good trading day, and we'll talk to you soon.
Thank you so much for having me. Take care, everybody. Bye-bye.
Thanks, Anne-Marie.